The solo 401k plan, I think, is a little bit more elusive as far as somebody starting their search into self-directed investing and then looking at a structure, finding out how to get into it. I think most people land on a self-directed IRA first when they start that journey. And then maybe by coincidence or luck, they'll end up finding out about the solo 401k in searching for and researching self-directed IRAs. So I like to present information on the solo 401k plans, but a self-directed IRA, especially an IRA LLC that gives checkbook control, will have a lot of the same benefits. They'll work in similar ways. And one of those big benefits is just the ability to invest retirement funds into alternative assets like real estate. So we go a little bit through the solo 401k here. This will be just a quick overview on that. So first off, if we take a look at what a solo 401k is, because that's a common question. So let me move this real quick. Okay, so it is an IRS approved retirement account. It's something that the IRS has to take a look at as far as plan documents go and make sure that those documents meet their guidelines for a qualified plan. So all solo 401ks should be IRS approved. With the solo 401k specifically, unlike other 401k plans, it's designed for a self-employed person. So the way we set it up, we actually have to make sure that somebody has some type of business or self-employment, and we'll get into that a little bit more in a bit too. Also, compared to other 401k plans, it's pretty easy to set up and operate a solo 401k. So as far as the plan being IRS approved, there's an IRS determination letter, which is a letter from the IRS, and it states that this particular plan document or whatever plan provider that you're working with, that their document meets the guidelines for a qualified plan. And that's stated in an IRS determination letter or an IRS opinion letter. And that's one of the things I recommend that you look out for if you are setting up a solo 401k, is that provider will give you an IRS determination letter with your plan documents. So that proves the compliance on the plan. And it also serves to give you peace of mind, because a lot of times people have questions around, okay, this sounds great, especially if they've never really heard of self-directed IRAs and 401ks. They may think this sounds really good, really promising, but if they're a little nervous about whether or not it's really compliant or if you can really do this, that can be an issue. So the IRS determination letter helps with that. So I mentioned before, it's essentially a self-employed plan, or that it's meant for or intended for self-employed individuals. That can really come in a lot of different formats. You can be a business owner, you can be self-employed, a 1099 worker. It can be as simple as driving for Uber on a regular basis. Any type of independent contractor type scenario. So if you do work and you're not employed by another business or somebody else that pays you on a W-2 basis, but you get a 1099 or you're technically an independent contractor, that works fine. So consultants, freelance workers, a lot of people meet these requirements without realizing it. So we'll talk to people sometimes and they're looking into self-directed IRAs, and we'll ask about self-employment activity and they'll say no. And then maybe they're a real estate agent or something like that. And then technically they are self-employed. So there are a lot of different forms this can take. And then one thing that some people find interesting or surprising is you can even be employed. So a lot of our clients, for example, are employed full-time. They have a job, they are actually paid via W-2, but they also have self-employment activity on the side. So that can be on a part-time basis as well, even if you're employed. Generally, these plans are pretty easy to set up and administer. And this is especially true compared to a 401k plan with a big business that has a lot of employees. And that really comes from the fact that the solo 401k does not cover employees, and that's what makes it solo. When you don't cover any non-owner employees, the plan administration is greatly simplified. You don't have to do the non-discrimination testing that is pretty burdensome from an administrative standpoint on 401k plans that do cover employees. That's what makes a lot of the plans pretty expensive, because you end up hiring a third-party administrator to do this type of testing and make sure that the plan is compliant with all of the rules. On a solo 401k, you're exempt from that. So that actually makes it easier for these plans to be self-administered. And when we set up a solo 401k, it is a self-administered, self-trusteed plan. That essentially means that you have a lot of control over that plan. The administrator on a solo 401k that we set up is technically the business that adopts the plan. And that business could be just an individual as a sole proprietorship if they don't have an LLC or a corporation set up. But the plan ends up being self administered. And then, as far as that administration being easier, one of the big keys here is that if it is a solo 401k, if it doesn't cover any non owner employees, there's actually no filing requirement for the plan if it's under $250,000 in total plan assets. Even if you go over that amount, and of course that's the goal for a lot of people, it's pretty normal to have a solo 401k with more than $250,000 in it. At that point, there's just a simple 2-page informational return that the IRS requires. It's called a 5500 Easy. And we publish a guide on that each year for our clients. We offer support on that. So I don't consider that to be too big of a deal as far as having to do it. You just want to make sure that once you pass that threshold, that you do actually do the filing. So we take a bit of a look at who can have a solo 401k. We touched on this a bit. A self-employed person, self-employed individual, a business owner, that can take a lot of different forms, but there has to be some type of business or ongoing self-employment activity that can adopt the plan. So that's essentially a business that says, hey, we want to set up this 401k plan for our employees. That's true even if the employees, quote unquote, are just the business owner. And that's typically the case with the solo 401k. Most of our plans are adopted by one person or a person and their spouse that works in the business. So that's true and possible as long as the business does not have any full-time non-owner employees. And one additional point I'll make on that, sometimes somebody will have a business that does not have any employees, and then they'll also have another business that does have employees. That scenario typically doesn't work because of what's called the controlled group rules. So in general, you just don't want to have any full-time employees in the picture. And then with some recent changes in legislation, even some part-time employees can eventually become eligible to participate in your plan, which would make it not a solo as well. So just a quick overview on this stuff here. If you do have questions on that, or you want to see if you are eligible for a solo 401k, I definitely recommend talking with a provider or even a tax advisor, just because everybody's situation is a bit unique. But in general, if you have a business or some type of self-employment activity and you don't have full-time employees, then a solo 401k may be an option for you. So moving on to why you might be happy about that being an option for you. Who would want, why would you want a solo 401k? It comes down to a few primary benefits. One of the big ones is definitely going to be the tax benefit. So depending on your age and your income, you can actually defer up to $67,500 per year for 2022. And you do have to have significant income in general to defer that much, but that's per participant. So in a scenario where we have solo 401k plans that are adopted by maybe a husband and wife that are both working in a business, you could double that number. The plans, at least the way we set them up, you can invest into just about anything. So that includes real estate, and they can be tax deferred or tax free. So a lot of people think about putting in pre-tax contributions, and that's very common, but the plan can also be set up to allow for Roth contributions. And unlike with IRAs, a solo 401k can allow for both at the same time. You could contribute pre-tax and Roth, which is a type of after-tax, in the same year if you want. You can switch back and forth depending on what works best for you at any given moment, but the plan can allow for both. And another really common benefit or a commonly used benefit is the fact that you can borrow from your solo 401k plan. This is another feature that IRAs don't allow for, but you can borrow up to $50,000 from your 401k. That limit is also per participant. So a married couple could potentially borrow up to $100,000. And you can use that for any reason. So usually when you take a distribution from your 401k, you're looking at taxes and potentially penalties if you're not 59 and a half. if it's what's considered an early distribution. But when you borrow from your 401k, on the other hand, you don't have those taxes or penalties. And then you can pay that back generally up to 5 years. You can set the term for. There are some scenarios specifically where you're investing or you're purchasing a primary residence with the money that you can go longer than that. But the big benefit there is just having access to that capital without having to pay taxes or penalties on it. Also, I would add that it keeps your plan funds intact because if you take a distribution, that money is no longer in your retirement account, and there's a limit to how much you can put in there. So I would consider those funds fairly special in that regard. And when you take a participant loan, not only are there no taxes or penalties, but once you pay it back to the plan, it's still in there. So you don't have to find a way to meet those contribution limits over time. It goes right back in. So if we touch a little bit on what a solo 401k can invest in, this is this is pretty key in the benefits, I think, because most of the solo 401ks out there are actually set up by a brokerage firm or some type of institution that will highly restrict what you can do with the plan. So the common scenario is you have a solo 401k with Fidelity or some other institution, and all you can do is invest into traditional assets with that institution, stocks and bonds and mutual funds being really common examples. But that's not by law. That's just the actual plan document that institution provides. Those restrictions are built in there. What a solo 401k can actually invest into is just about anything. So we talked about these plans being really useful for those who want to invest into alternative assets. Real estate is probably the most common example of that. It can take a lot of different forms, though. Precious metals like gold and silver, and that doesn't have to be just some type of gold-backed stock or other security. You can actually have the physical asset. You might want to have that stored with a depository, just based on prohibited transaction rules, which we can touch on as well. But actual physical ownership of precious metals is allowed in IRAs and 401ks too. So private companies, that's a big one. Typically, when you're just investing in the stocks and mutual funds, those are all publicly held companies. Private companies could be if you know somebody that you trust and their company's doing really, really well. If you want to invest into that with your retirement funds, as long as they're not certain family members that own that company, you can generally do that. So that doesn't mean that you can't invest into stocks, bonds, and mutual funds as well. So a lot of our clients will open up a brokerage account for their solo 401k in addition to a checking account that they may have for their plan. And then that gives you access to both types of investments within the same structure. And you can actually move funds freely back and forth between, say, a brokerage account and a checking account that you use to invest into, tax liens or tax deeds or real estate, without having to do an actual retirement account distribution. So that's one of the benefits, I think. If you're interested in multiple different assets, you can have several different accounts set up according to how you intend to use the plan. So mortgage notes, tax liens, tax deeds, cryptocurrency, just about any legal investment you could do with a self-directed IRA or even more so a solo 401k. The primary difference there would be insurance. IRAs aren't allowed to invest into insurance, whereas 401ks in some instances you might want to, or you're actually able to at least. So in general, the solo 401k is considered the best retirement account that somebody can have because of the high contribution limits and the large amount of flexibility that you have with it. That's not to say that the self-directed IRA isn't a great way to invest as well. The major benefit there, I think, with the self-directed IRA is that you don't have the eligibility requirements of a solo 401k. But if we do look at the solo 401k benefits, you have the unlimited investment platform that we talked about, all of the different assets that you can invest into. And in my opinion, at least, when you have more options for investing into things with your retirement funds, you just have a much better chance of getting good returns on that money. So when stocks maybe aren't doing so well, or there's a certain sector that isn't doing well, they talk about diversification. Well, you can actually diversify outside of the stock market and have exposure to a lot of different asset classes, and these plans allow you to do that. So the high contribution limits, at least with the solo 401k, those limits are about 10 times higher than that of an IRA. So that's one of the reasons that somebody will potentially look to this type of structure if they're eligible. The tax benefits that we talked about, especially the fact that you can put in money pre-tax or Roth, which is after tax, and then in that case, all of those assets would grow tax-free. And a lot of times people will ask about whether it's better to do pre-tax or Roth. You do get a benefit either way. So that's one of the things that I try to make clear. What's better for you is definitely something that you might want to talk with a tax advisor about, just because everybody's situation is different. But if you expect yourself to have a really high return on investment, really high um, percentage gained within the account after you put the money in, that's an argument for the Roth. And that way you're paying taxes on the seed instead of the larger harvest. But either way, you get a good tax benefit, and that's what I usually try to make clear. Those Roth provisions are included in the same plan rather than with an IRA. You either have a traditional IRA or a Roth IRA, but one IRA can't be both. There is that participant loan feature on the solo 401k. And then this is a pretty good benefit that sometimes doesn't get talked about enough. When a spouse can participate in the same plan, you have one structure. And if you're setting it up with a plan provider, they oftentimes will charge a setup fee and an annual fee. You have just one set of fees when there's one plan, even if a spouse is participating. And that doubles some of the benefits. So you double your contribution limits, you double your participant loan limits. So spousal participation can be really nice in that regard. And then with the solo 401k, because there's no custodial requirement the way there is with an IRA, you have checkbook control without the need for an LLC. When you do have an IRA and you want checkbook control, that's why I mentioned the IRA LLC earlier. That's required. So the IRA custodian has control over the IRA assets. But if the IRA assets are an LLC that you manage, then you have checkbook control over all of the assets inside of the LLC. So that's a really beneficial structure too, and a great way to proceed with an IRA if you want checkbook control. But with a solo 401k, you don't need that LLC to have the checkbook control. As we mentioned, it's IRS approved. It should come with an IRS determination letter that states that fact. And it's fairly easy and quick to set up. So it's pretty typical nowadays for most plan providers to be able to get documents out in a day or so after they get all the information that they need to complete those documents for you. With an IRA LLC, that can take a bit longer, and that's just because there are more moving parts to the process. You deal with the Secretary of State setting up an LLC. An operating agreement has to be formed, and there's also an IRA custodian involved. And typically because of some of those benefits, and as well as the fact that it's quicker and easier to set up, it tends to be an exceptional value when you're looking at self-directed investing. When we started our business, we focused on the solo 401k for these reasons. But if you're looking at an IRA LLC or you're not eligible for a solo 401k, the self-directed IRA structure comes in a few different forms that you might want to look at, and that's obviously a great structure as well. Okay, that's it for the presentation that I have there on the solo 401k. If there are any questions, we can get into those, or specifically the differences on the IRA LLC and a solo 401k. But they both can invest into alternative assets like real estate, and they both offer checkbook control potentially.
Awesome and great presentation, Justin. So, is there any limitations using self-directed IRA?
There are limitations. The primary limitation would be what's referred to as prohibited transactions. And those are rules that are set in place for maybe a couple of reasons. And some of the reasons may be a bit debatable. So a lot of times I'll explain it that the rules are designed to eliminate any conflict of interest between what might be good for the retirement account, whether it's an IRA or a 401k, and what might be good for the person that's running or managing or participating in that account personally. So, a good example might be, let's say you have a solo 401k set up, or even an IRA LLC. The structure can invest into real estate, but you want to purchase real estate that you already own. So there's something that you own personally, or even in a business that you own, your IRA or 401k could not purchase that. So it cannot transact with what the Internal Revenue Code has identified as a disqualified person. So a disqualified person would be the account holder, number one. It would be certain family members, so starting with a spouse, and any lineal ascendants like parents and grandparents, as well as any lineal descendants like children and grandchildren and spouses of lineal descendants. So these disqualified persons are off limits for transacting with the retirement account, and you can't indirectly benefit them either with the transactions of the retirement account. So in that scenario where you have a self-directed IRA or a solo 401k that can invest into real estate, but you want to purchase property that you own, or maybe a parent owns it, that would be disallowed. So that you couldn't do, and that's a big limitation to be aware of, because those prohibited transactions, the penalties can be pretty severe for that. But you could purchase real estate from anybody else out there. There's so much more that you can do that is allowed than what is disallowed. And one way to look at it is, well, if you do purchase a property from yourself in your retirement account, are you purchasing at a fair market value? Are you doing something that maybe you're trying to get some additional cash in your hands by that sale, and you're getting cash from your retirement account? So then the question comes up, is that really a good investment for your plan, or is that something you're trying to do in your own interest? So that's one way to look at the prohibited transaction rules. The other, possibly more cynical way to look at it is, if you are going to benefit yourself in any way with the retirement account in the short term, the IRS wants tax revenue for that. So they allow you, or the code allows you, to put contributions into these plans and let them grow tax-free or tax deferred. But there are conditions to that. Essentially, that's not for your use now. You can't write a check out of your solo 401k to make your car payment. That's for your use later on, presumably in retirement, when you start taking those distributions. So if you're going to go against that, if you're going to have some kind of benefit now, then the IRS wants taxation on that, or at least those funds to be pulled out of the retirement account and into your name before you do that. And there are some exceptions to that, but those are the general rules with prohibited transactions. One notable exception being the participant loan feature. You can borrow from a 401k plan, and that would be a prohibited transaction if there wasn't that exemption for that particular allowance.
Got it. Yeah. Can we borrow from a checkbook or self-directed IRA account?
With an IRA, you cannot. The loan feature was just set up in a different part of Internal Revenue Code that doesn't get pushed onto IRAs. So you cannot borrow from your IRA. And to be clear, because we have a lot of clients that may want to do private lending out of their IRA or a 401k, you can lend to others. So that's an allowable investment. Maybe a common example would be if you have a real estate flipper that is looking for some revenue, they have a good proven track record, you can provide that. You can provide that as a loan to them, as long as they're not a disqualified person to the IRA or the 401k. But you cannot borrow from your own IRA. So there's no participant loan feature with an IRA, but there is with the 401k, if the document allows for it.
Got it. Got it. And can you share your contact details and how exactly your company can help, setting up this, self-directed IRA account?
Sure. Yeah. So the company is Discount Solo 401k. We do set up solo 401k plans. We can provide IRA LLCs as well. And the IRA LLC is the format of a self-directed IRA that does give checkbook control. So we do specialize in checkbook control. Our website is discountsolo401k.com. We've got some free information there. You can request more information online as well, and we can send that over to you. And our phone number is 303-427-4519.
You have anything, any, contact details on the slide?
So yeah, just the actual web address there, discountsolo401k.com. But that's okay. I'm happy to provide information. And if this is helpful to anybody, I freely encourage you to search out there for solo 401k plans, self-directed IRAs, and IRA LLCs, and just increase your education and work with any provider that you feel comfortable with. I think they're great structures. And the more good investors that we have out there getting great returns, regardless of what company you work with, the better that is for the industry. And of course, the better that is for just investors as a whole. So I think that's a really positive thing.
Cool. So there's one question from Fanindra. So
Mhm.
what are the typical charges or fees for managing this solo 401k?
The setup charges and fees.
Yes.
Okay, so I'll give you a general answer on that, and then specifically with us. So in general, the fees tend to range from about $500 up to, I mean, you can almost pay as much as you want, but a couple thousand for a solo 401k with checkbook control. And then the annual fees are typically anywhere from 100 to 500, and you can probably find somebody charging more, but that's where most of it falls. And it's important to point out, I think, that when you have checkbook control in a solo 401k, you have that setup fee and you have an annual fee. That's in lieu of any transaction based fees or asset based fees that are typical when you don't have checkbook control. So it can be a lot less expensive to have the additional control and flexibility that a checkbook type plan or IRA provides for you, compared to having less control where you go through a custodian or another type of administrator to process the transactions on your behalf. Depending on your asset value and the number of transactions you can do, you end up doing, you can have more benefits and less money. With us specifically, our standard setup fee is $575, and our annual fee is $100 per year. And we'll often do specials, and there's one that we have been running for quite a while where the setup fee is just $250, and it's a slightly higher annual fee at 125. But if that gives you an idea of the pricing, then in general, it's a fairly affordable plan. And even more so when you consider that a lot of our clients have existing retirement funds that they're rolling into this account. So they're starting with a really large balance that they have access to and can really put to work into alternative assets. But if somebody has maybe pretty decent self-employment activity, pretty good income, and they don't have existing retirement funds, sometimes just putting a few $1,000s into a plan as a contribution makes it pay for itself with the tax deduction as well. I think I would just mention that, the what I like most about setting up these structures is just that the end user, the client, the investor can really invest into whatever they feel comfortable with, whatever they feel is going to be the easiest for them to get good returns with. We don't sell any specific investments, so that leaves the client free to do what they think is best. And if you're looking at real estate or syndications, that's something that becomes possible with an account that provides these tax benefits that you wouldn't have access to with the typical mindset of real estate investing, which is outside of an account. And that's not to say that it's not great to invest into real estate and syndications with, personal funds or with business funds that aren't inside of a self-directed type of an account. But it's just nice to consider all of those options. And I think a lot of our most successful clients are doing both. They're investing into what they know and understand, and feel they can get good returns with, both outside of retirement funds and inside a retirement account.